Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On the Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Ryan Stieg. Ryan, since 2016, has been investing in a small portfolio of 1 to 3 rental units across 6 markets in the U.S. He has also invested in well over 50 real estate syndications, individually and with groups. Ryan has invested in note funds, land, multifamily, mobile home park funds, life settlements, development projects, crypto, all kinds of stuff. You could say he has a little bit of that shiny object syndrome, which we all do from time to time, but he's definitely ran with it and put his money there as well. So anxious to hear your story on that. And then he also is the founder of LeftField Investors, which recently merged with and to form BiggerPockets, which is under the BiggerPockets brand, and also operates a fund as a fund manager with InvestWise Collective. Both businesses focus on passive investor experiences ranging from education, networking, and deal sourcing and funding. So, Ryan, welcome to The Wealth Flow.
Thank you. Yeah, I guess from that you can tell I have shiny object syndrome and kind of run in a few different directions, both entrepreneurial and as an investor. So yeah, but happy to be here.
Yeah, well, happy to have you, and I can't wait to dive into your story. I like to typically start with Ryan. Your background, where you grew up, and what eventually led you to real estate investing.
Yeah, so I grew up in Billings, Montana. My dad was an entrepreneur. He had an insurance agency that he started, and I kind of worked in that business growing up, mowing lawns, doing filing, all the stuff that you do as a child of an entrepreneur in a small business. But I didn't really connect the dots to some of the things he was doing. And one thing that was connected to real estate was they would buy an office building, become the tenant, and then as the business grew, they would keep that real estate, build a new office, and so on and so forth. And so I didn't really connect those dots as I was growing up. But when I got into college, I was interested in finance. And as a sophomore, I read a little purple book that a lot of people in real estate have read called Rich Dad, Poor Dad. And it kind of connected those dots for me to what my dad had been doing as kind of part of his business all those years. And so I was going to school in Phoenix at Arizona State at the time. And when I read that book, I thought, hey, real estate sounds kind of fun. Let's look into this a little more. And so I connected with a local real estate investor in Phoenix, and we just kind of worked together. And I kind of just was running around doing pet projects for him, but learning the business. And graduated from school, and once school was over, bills pile up, and I didn't stick with real estate at the time. So went into the mortgage industry and eventually came into the family business in insurance. But real estate was always kind of an itch, and so when we moved from Phoenix back to Montana, I had become an accidental landlord. The house we bought in Phoenix wasn't great timing to sell, and so we put a tenant in it and kept it for several years. And I became comfortable with remote property management, so I didn't have to be there. I could trust the property manager, and so I at that time I was still working in insurance and still had the bug to get into real estate. And I had heard about a concept called turnkey real estate. So that was my entry point. The numbers didn't make sense exactly where I lived, and so the concept of turnkey was appealing to me, where I could invest in single family units, small multifamily 1 to 4 unit projects that really were about as hands off as you can be as a direct real estate owner. And so we started investing in some single families and small multifamilies in cash flowing markets like Memphis and Cincinnati and Kansas City, and grew a small portfolio there. But I got to the point where I realized that growing the portfolio to the size that I would want it for the cash flow that I wanted was going to be buying me another full-time job. And so we stopped acquiring direct rentals. And through Podcast University, this was probably 2015 or 16 at the time, I started to learn about the concept of passive real estate through real estate syndications. And so when I started investing there, I was doing it all by myself. I'd listen to podcasts to and from work and on my road trips, and I'd hear about a syndicator, great marketer, great deals.
Yeah.
16, 17, 18, everything was a home run. And so I started investing in that. And I went to a meetup in Phoenix with one of the syndicators that I was investing with, and I met a guy named Jim Pfeiffer. And we hit it off, and we said, "Hey, I'm doing this alone. You're doing this alone. I don't really know a ton of people in the space. Let's follow up and have calls every once in a while." And so we did biweekly calls for a couple of years, just talking through the investments we were looking at, kind of doing some due diligence together. And in 2020, he was running, or late 2019, early 2020, he was running an active real estate group in Columbus, Ohio, and said, "You know what, I'm going to branch off and I'm going to go into building up a group that wants to talk about passive real estate." That was March of 2020.
Yeah.
A turning point for a lot of people. And
That's
so
right.
that first meeting was supposed to be in a dinner club with 10 people, and it never happened. And so he pivoted and turned to this little thing called Zoom, where everybody was getting on video now because we couldn't meet in person.
Yeah.
And so he reached out and said, "Hey, we're going to start this passive investing group, and we do you want to just join, because it's going to be virtual?" And that kind of opened the boundaries of geography, holding back what was otherwise going to be just a local dinner club in Columbus, Ohio. And so we started LeftField Investors, and it was a group that was just ready to help passive investors or those interested in the space to network, learn, and just kind of do investing together and find deals together. So there's obviously more to the story, but I think that's kind of a turning point for how I got into real estate and what led me to kind of mainly where I'm at today. So
Yeah, there's obviously a lot there. Just curious on your, you fell into being a landlord similar to a lot of folks. Just the house that didn't sell, the house maybe you didn't want to sell. That was one of my first rentals as well. It was just our first house that we built, and we had built it. We kind of had a little bit of an emotional attachment, but found a deal that we just couldn't pass up, and so ended up moving out of that. But became a landlord. But as you started to buy other stuff, you said, you got comfortable with being able to manage things that maybe weren't right in your backyard. Why did you choose some of the markets that you chose? Was there a particular reason that you looked at those? And, maybe for the benefit of the audience who maybe wants to still be a little bit more on the active side, what were maybe the top 3 lessons you learned as far as being able to do that remotely?
Yeah, the first one is comfort. I talk to a lot of investors anywhere, and they just they can't get past that mindset of, if I'm not there to go fix the toilet, if I'm not there to go help the tenant, I don't trust someone else to do it, and that is a hurdle.
Yeah.
If that's where you are as an active investor, and you want to have that hands on, you bind yourself a little bit to your local market. But that was the first hurdle that I again accidentally fell into, because we were moving and we were keeping that rental.
Yeah.
The reasons I picked the markets were cash flow. Where I was at in Montana, buying the same property wasn't going to cash flow like a Memphis or a Cincinnati or a Kansas City, which were some of the first markets that we started with. So just the numbers made sense, and so I went where the numbers made sense, and so those were really the first two things: is just being able to have a comfort level of doing your due diligence on the property, but mainly the property manager being the key there. I mean, you can have a great property and a bad property manager. You can have a great property and a great property manager, but the real key to that whole thing working is a reliable property manager. So
Yeah, for sure, for sure. And now, do you still have some of those rentals, or have you sold those off?
yeah, we sold one that was a problem. We sold one and have kept the rest. So we still have a small portfolio of 1 to 3 units.
Okay, fantastic. And love the title. What led you to choose LeftField Investors as kind of what the group was going to be all about?
Yeah, that was so Jim, the founder of LeftField Investors, who rolled from an active to a passive group. He used to be a financial advisor and kind of lost heart in what the stock market was doing at the time, and just really felt like real estate was his ticket. And he'd go around the office and talk about real estate with his financial advisor buddies, and they'd be like, Jim, you're way out in left field. We don't care about that stuff.
Yeah.
And so he's like, well, I guess we are LeftField Investors. So
Awesome.
That's how the name started.
That's a great game, or a great name, and it's true. A lot of people, they know their 401k, they invest in that. It's kind of the traditional route, and some of this other stuff does appear to be out in left field, but can be very good. That's neat how also the two of you kind of pivoted and did this group during COVID virtually, which probably, and you can tell me, what your thoughts are on it, but it may have actually been better that it was created that way, just from the sense that, yes, you don't get that, local community where you can get face to face with one another in person, but there's no geographic boundaries. So now you're able to look at and explore, investments all across the U.S. with, being able to do it virtually.
Yeah, virtually really was the impetus to me being involved with it. There was a group of there was a group of us that started this. We have one founder who was in Virginia, myself out in Montana, and the rest were in Columbus, the Columbus, Ohio area, that were part of that original group. But if it weren't for Zoom, we wouldn't have the gentleman and I that are from Virginia and Montana, we wouldn't have been involved. And the group was intentionally trying to find a free space in Columbus, so they were going to limit the group to 10 or 12, whatever that kind of the size was for a steakhouse in Columbus. And so Zoom was really why it grew geographically. And so yeah, we were able to have members from all over the country, and eventually that then make that connection with BiggerPockets to form Passive Pockets and carry the business on through Passive Pockets.
Okay. And so at this point, had you already started to invest in some syndications, or did you kind of get involved with that with LeftField Investors?
Yeah, great question. So Jim and I, before LeftField Investors started, Jim and I had invested in a couple syndications ourselves, but just like with buying rentals, cash goes quickly when you're paying a down payment or you're investing at those syndication minimums. And he had a local connection with a company called TribeVest. Travis Smith is local to Columbus, and he's the founder of TribeVest. TribeVest is basically a platform to allow groups of investors to form an LLC and have that entity infrastructure. So in 2019, even before LeftField Investors started, Jim and I had said, hey, let's find a group of people and let's split the minimums so we can diversify our portfolio and not have to go all in on fewer deals. And so that's the number that you mentioned earlier of syndications I've invested with. Sounds a little ridiculous, and at times it feels like it. But a lot of those were split with minimums that were split among a group of people. So it was easier, almost like buying a stock portfolio. It was easier to get in at smaller minimums and diversify our portfolio both geographically by operator and by asset class by splitting those minimums.
Yeah, makes sense. So, like, for the audience or the benefit of the audience, a lot of times these investments have a minimum investment amount of $50,000. So, when you're looking at 50 investments, that's $2.5 million. So, which not that people don't have that, but the average Joe or the average Ryan may not have that just sitting in the bank ready to deploy to some of these. So. It's a cool concept. So tell us a little bit about how you guys structure those and sort of, how much do people invest? I assume it may be whatever they're comfortable with. So maybe there's various amounts within that initial investment, but tell us a little bit about that and how you guys field some of the investments that come across. Is this something you get together on Zoom and talk about, hey, here's an opportunity, here's what we're looking at doing. And here's basically the pitch deck that they're sharing with us. What are the pros? What are the cons? Kind of talk about it as a group, and then whoever decides they want to invest kind of puts their money in that individual one, and you guys invest as a kind of a group.
Yeah, there's as we grew, we found several different use cases. So one tribe, as they're called through TribeVest. One tribe was basically a smaller group of people who liked a handful of operators. And so we just divided the investment minimums by 5. And we would say, hey, let's vote on every deal that comes from these operators, and we would either get in or not. So that was one use case. And the benefit of being part of the LeftField Investors is we had several hundred active members who all wanted to invest differently. And so there was one tribe that was more exploratory, like asset classes that we weren't familiar with, or geographies or operators that we weren't familiar with. And so it was we had a much bigger group, but we were splitting those minimums to relatively smaller amounts in the hundreds, so that we could learn more about the operator, more about the asset class, more about the market before we might get in on our own or at larger minimums. And then there were some educational groups too. So people who wanted to explore the space but didn't have the minimums could invest through a tribe and just learn about it without having those, probably traditionally $25,000 or $50,000 minimums, which are unattainable to a lot of people. And really, you don't want to. Some people just don't want to make that first investment at that amount. So we found several different use cases for those tribes, and then as deals would come in, also by being a part of a community, we had more deal flow. We could do due diligence as a group, and then we could vote through that entity structure through TribeVest. So again, there was several different use cases for how and when and why we would invest.
Okay, and maybe for the audience as well, what does that look like? As far as being able to monitor and see your investment, the distributions, how does all that work kind of in the background on these? Obviously, if you were going to go ahead and invest directly with a sponsor as a limited partner, you would be sent the distributions directly. Are they coming first to the LLC and then being distributed out from there? And I guess maybe again, end of year type stuff, K1s, that kind of thing. How's all that handled within that system?
Yeah, and that has, as TribeVest has grown, that process has changed a little over the years. But essentially, the platform allows it to form the entity, to house the bank account for the entity, and to hold the documents and voting for the entity, as well as process the taxes at the end of the year. So, for example, if we have Keith and Ryan's LLC and the distributions would come into the entity bank account, and then we would vote on, do we want to hold those and reinvest in new or different deals, or do we want to just take distributions and hold back for any expected expenses for taxes or bookkeeping or any entity expenses like that. So it's really up to the entity to decide those things. But yeah, the distributions come to the bank account. The operator emails and updates come to a collective email, and then those are distributed and handled through that platform.
Okay. And what about just being able, Ryan, to invest in that many opportunities out there and that many different asset classes? I'm sure there's some things that you've learned along the way, things that maybe you like, maybe lessons that you say, well, gee, maybe on the next one we won't do this or whatever the case may be. But what are some of those types of experiences that you've and lessons that you've learned as you've kind of invested in, such a diverse type of portfolio?
Yeah, I think a couple of the high level lessons that I learned. One is there's a big difference between a great marketer and a great operator.
Yeah.
There are some that have the best pitch deck. They look great. They're great presenters, but execution at the business level just it doesn't equate to the level of expertise in marketing and attracting capital. So really being better at analyzing who's going to be able to execute. You've probably heard the phrase before, you're betting on the jockey, not the horse.
Right.
And kind of like what the analogy I made with the direct rental ownership, a property manager is key to the success of that property. And even more so at a much larger scale, the operator and their ability to execute on the business plan is key to what could be a great underlying deal, but a bad operator can do harm and not execute on the business plan. The other thing too that I learned over the last couple of years is just the to be do more due diligence on the effects of debt. A lot of what was going on in the multifamily space, which is where a lot of people started, was bridge debt, and it seemed like that was a quick hitter, and it is leverage is a double-edged sword, and it works both ways. And so there were some unfortunate learning experiences with what bridge debt can do in a rate cycle that goes up and an economy that changes for that specific asset class very quickly. So I think those are some of the things that the top level things is just really understanding and vetting the operator to understand their ability to execute on the business plan. I'm always fearful of someone who will say I'm an expert multifamily, and when the tides turn, now I'm an office guy or a self-storage guy or something. When you're flipping asset classes, that scares me a little bit. Not that it can't be done or that you can't hire an expert team, but those are some of the things at a due diligence level that I really believe the operator is the key to all of it. And we've seen some of that. Some of the operators that were around well before the rate increases are hanging in there, even if it's tough. They're hanging in there, and others just didn't. So
yeah. So and on a lot of the deals or some of the deals, have some of them gone, south or gone sideways that you and some of the other folks in the group have invested in?
Yeah. There are some that I personally invested in, and some that others have that haven't performed, and that goes with the stock market too.
For sure.
There's stocks overnight, but yeah, the learning experience was that there are market cycles, and you have to understand. One of the things that I really like going forward now is multiple layers of sensitivity analysis. What happens if the projections don't hit? What happens if our rent growth doesn't go where we think it will? What happens if expenses are much higher than what we thought? What happens if our cap rate projections are higher or lower? And just looking at evaluating the multiple layers of sensitivity analysis that will impact this. And going back to my initial investments in 2018 or 2019, looking at the potential impact of bridge debt and what happens in a changing rate environment would have been much more helpful, and I would have made better decisions knowing the impact of what that debt can do. And debt is just a tool.
Right.
It's not right or wrong, but it's a tool, and you have to know the best way to use it and the impacts of that tool, using that tool. So, but yeah, just doing a better analysis of understanding debt and just lessons learned over the course of the last several years.
Yeah, for sure. Is there anything particular you look at now when it comes to the debt? Obviously, the type of debt on there, but any specific amount of leverage that you like to see or don't like to see?
I wouldn't say that there's a specific level, although I'm much more cautious with that level of debt. I've shifted my focus more to cash flow and capital preservation being primary for me in my investment criteria. Whereas earlier, the equity multiples and returns, as you're learning the space, seem juicy and they look great. But as I do due diligence now, I prioritize cash flow and preservation of capital over equity multiple, if that makes sense for kind of how to look at it differently.
Yeah, for sure. And then how about asset classes? Any particular ones that surprised you that you've invested in either a good way or maybe not a good way? Anything that you've seen that's just been kind of a neat anomaly that's out there when it comes to some of these. And not to say that there are some that I'd be interested in hearing about the life settlement stuff as well. I've interviewed a couple people that have been involved in that, but it's always an interesting one that half the time, most people don't recognize that you can actually invest in life settlement. So
yeah, there is a lot of interesting asset classes, and that was one of the fun parts about the kind of the exploratory tribe that we had formed, is getting into stuff. I had never invested in car washes or crypto, life settlements, but specifically about life settlements. That one it's underperforming, but I still believe in that asset class, and I'm only in one, but that one in particular, and it sounds morbid, but it is just kind of how that asset class works out. There's no real predictability. There's analytics behind that, but there's no real predictability for how that will perform. I would say that one that stands out to me as a personal favorite, it's not everybody's, is industrial. When inflation was going crazy, I was thinking, man, their those long-term leases aren't going to keep up with inflation. They're going to be, there's better performing assets. And then when the market changed, that's where stability was. And that's one that, again, going back to cash flow and capital preservation, that's just one asset class that I've grown fond of. And multifamily is still appealing to me, but now I just know the pros and cons of what I look for as an investor and what risk I'm willing to take. And I think as any investor, our risk tolerances may change over time, and mine certainly has too. So, but yeah, I've grown a fan of debt recently. I like private debt. I think there's a unique space where we're at in the interest rate environment right now, where private debt is really outperforming a lot of other metrics for equity positions. So I like private debt right now. Not always, but I like private debt right now. And then I do still like multifamily, but industrial has been a kind of a consistent top performer for me.
Yeah, and on the private debt, explain that a little bit. What type of private debt are you investing? Obviously, there's a wide variety of different funds out there. Some that focus more on fix and flip type stuff. There's some that'll do kind of almost bridge debt type commercial lending. There's a wide variety, right? Underperforming notes, bringing them to performing. Just so many different things. But what are some of the ones that you focus on and that are appealing to you?
Recently, it has been more along the lines of the fix and flippers, and the funds that I've invested in are long established, and also have a great track record with their borrowers. So uh, this isn't hey, Ryan's going to go now chase another shiny object and try try his hand at fix and flipping. These are repeat borrowers with the same lender, uh, having a successful track record of projects. Not that everything goes perfectly, but uh, really, the best in class are going to have a low default rate because they know who they're lending to, they know their risk profile, and they're underwriting those loans consistently and prioritizing return of capital over any kind of other return on capital. So. Yeah. Fix and flips and just straight residential lending, and then there are some also that are in that commercial bridge debt space where they're understanding the risk profile of the equity remaining in the deal and the ability to, if things go south, the ability to turn quickly and be able to flip that asset if the underlying property doesn't perform with that lender. But the fix and flip space and then commercial bridge debt, as long as the underwriting criteria is solid and repeatable, those are some that I like right now.
Okay. And maybe tell us a little too about kind of this new partnership with BiggerPockets, and I guess I wasn't even aware that they had a passive pockets. Kind of under the umbrella. I know they've branched out and done a lot of things differently over the last couple of years, but obviously it's one of the bigger players in the space, or the biggest player in the space, maybe.
Yeah.
And so kind of cool to be partnered with.
Yeah, I have to say it was really a full circle moment for me when we made that connection. I mean, I started like a lot of people in real estate, listening to BiggerPockets, listening to the podcast, reading the books on the website, and then we started talking, and really our communities were kind of a perfect marriage for. We had we were a bootstrapped company that was a small group of founders. Many of us had other jobs, and so it was, from a resources standpoint, it was difficult to grow that business. So we were finding constraints in our ability to grow an unintentional business, so to speak, and they were finding too a lot of the active real estate investors who either leave or quote unquote kind of graduate from BiggerPockets land in something like LeftField Investors. Hey, I'm ready to get out of active investing, or I don't like active investing, or I'm ready to retire and not have this active commitment. There's a number of different reasons why someone would transition from active to passive. And so that was kind of a concept that they had, and we had already had a community, and it just seemed like a great synergy to help them form passive pockets, and for us to kind of carry on the LeftField Investors community beyond what we were able to carry it to, just with our limited resources there. So it's been that was last August that we formed Passive Pockets, and it's been an incredible team to work with. It's very impressive to work with BiggerPockets and that whole team, and the synergies that we've had since day one have really been remarkable. I've sold a couple businesses in the past, and it doesn't always go as planned from day one. But the BiggerPockets team to form Passive Pockets has really been an enjoyable experience, and we look forward to carrying it on and seeing what we can do to just help bridge that gap for people who are trying to either graduate from, or grow outside of, or transition from an active portfolio.
Okay. And what are some of the maybe resources and things that folks can gain by being part of that group?
Yeah, I think a couple of the things that are really helpful. is the forums. The forums are, it's just a place to connect with community members. Uh, if I'm interested in a certain asset class or wondering about a certain operator or just learning the space, I can be brand new. You can find someone to connect with or a resource to connect with. Uh, there are plenty of resources as far as uh, a sponsor screening tool or uh, blog articles. There are a lot of contributors to a course that was built just to help people onboard that experience. And we recently launched what we call the LP Deal Review Committee. And so basically, there's a committee of experienced limited partners that'll hop on a podcast and just review a deal as though they're reviewing it for themselves. And so that we've had really good feedback about that because it just helps. When I started, I didn't know what questions to ask and I didn't know who to look at. And so it's just providing a resource and getting the reps as an investor without spending the money, so to speak, and just understanding better how to do due diligence as an investor, even if you're already good at it, there's always something to learn about how you can be better at analyzing a deal.
Yeah, for sure. No, it sounds great, and yeah, that is neat. A lot of times, like you said, you just don't know what questions to ask, or you might hear the same information that somebody else hears, and not quite come up with what's the next question on it. And just somebody, in other words, somebody could explain something to a group, and we've been on a couple different group investment calls, and I've noticed that some of the guys catch on to something that I'm just totally oblivious to. I might listening and think, "Oh, this sounds great," and then they start drilling them with questions, and I'm like, "Oh, wow, that does raise a little bit of a concern," or whatever it may be. Just it's neat to be able to see that from somebody experienced.
Yeah, and I think that's a great point. One of the things that Passive Pockets does is we bring sponsors to the community to bring their deals, and we have a ratings and review profile where you can go out and have that experience with an operator and rate and review them, good, bad, or indifferent. That gives people some context for who you're working with and what actual investors' experience has been. And to your point about seeing things from a different perspective, Steve, who was one of the founders of LeftField Investors, he really harped on IRR partitioning, which isn't something a lot of people talk about, but it's basically broken down as to the returns broken down into when you get those returns. Are you getting cash flow from day one and you're de-risking yourself along the way, or you get no cash flow and it's kind of like a development deal and you're just hoping for a home run at the end of the day that meets those performance metrics? So, but that was something I had never thought about or never really. So having those different perspectives, you might have looked at 100 deals and never thought of something that is a factor that you'll factor in going forward. So it's just a continual learning experience.
Yeah, for sure. No, that's great. And so, and then beyond, what about like, InvestWise? Tell us a little bit about what you're doing with that as a fund manager.
Yeah, InvestWise was kind of a brainchild of what we saw at LeftField Investors, and so there's four of us that run InvestWise Collective, and basically it was being able to run curated deals to a group of investors in a format that was regular. LeftField Investors wasn't a registered advisor; we were just a community. We weren't a 506c or 506b, and so the regulatory structure meant that we would have to do something like that differently. And so there's four of us that. And that's how I'm investing in debt deals. We found a couple debt deals that we like. We recently found a multifamily with a co-GP that we like in Louisville, Kentucky, and so it allows us to be more proactive on the deal sourcing and capital raising end of it that we just didn't have the framework to do with LeftField Investors. So that has been a fun project to again get better at finding and sourcing deals from different areas, different networks, and to bring that to a group of investors through a 506c that has been a fun experience.
Okay. And so is that like a kind of a fund to funds model where you're bringing a specific amount of capital to a deal, maybe negotiating some better deals with the operators, or how is that structured?
Yeah, a couple different ways. Initially, when we started out, yes, it was a customizable fund that was essentially a fund of funds, and so we would go to we would go to sponsors that we know and felt comfortable with, and had underwritten written and done due diligence on, and we were able then to either provide better returns or structured returns through the fund of funds structure. But a lot of what we found in this last market cycle was just an access play. Some of the best deals out there had investment minimums of 250 or $1 million that just isn't accessible to a vast majority of investors uh,
Uh-huh.
out there. And so we were able to bring those investment minimums down in some cases to 50 or 25,000 versus the 250 and $1 million thresholds that a lot of those had. We're transitioning a little bit now. We have this deal in Louisville that we're co-GPing on with another multifamily operator that has had success in the area, and so it just presents us different opportunities to source deals either as a fund of funds or potentially as a co-GP and being much more involved at the project level.
Okay, perfect. And let me ask you this, Ryan: is there anything on your businesses that maybe I haven't asked that you were hoping I was going to ask, or something that we haven't dived into yet? Just want to make sure that we don't miss anything for the audience here.
Yeah, no, I appreciate that. You've done a really good job of covering all the shiny objects that I've chased down over the last several years. So, no, I think we touched on kind of the origin of LeftField Investors and myself as an investor, and then the transition to passive pockets, and also the involvement in InvestWise. So, you've done a great job as an investigative podcast host. So.
Awesome. How about just general feelings on the market over the next 1 year, 2 years, 3 years? Kind of what are you seeing in the landscape? I know obviously none of us have a crystal ball, but I swear if I ask enough people on this podcast, I'll have a little bit more insight.
I am probably one of the most indecisive guys you'll have on. I'll I can argue both sides of the story.
For sure.
Um,
Yeah.
and you know what? I think the sentiment over the last couple of years to me has been, okay, the tides are changing. Multifamily isn't returning, 18 months, double your investment, and we'll exit and move on to the next one. That just isn't the world we live in at now. So I think there's a changing investor perspective. If you've been in the space for a while, you probably licking some wounds, and also you're not seeing what you used to see for projected returns a couple years ago. So it's
Yeah.
a changing perspective. And then I also think that uh, there's a little bit of, well, I think there's a lot of capital on the sidelines that's trying to time the market. Um, and I know enough to know that I don't know how to time the market. So
Right.
a little bit of that is kind of driving the dollar cost average into what I know and feel comfortable with. Um, I think multifamily, we heard a lot over the last couple of years, survive till 25.
Mhm.
And there's still some of that, but rates haven't dropped back down like some had anticipated. And sellers aren't as willing to sell as maybe some had thought. So there's still a gap in buyer and seller expectations. I think that'll turn at some point, and I think that there's coming a time to get back into equities more. I think that debt, it has a place to stay for longer than it maybe has in the last couple of rate cycles. I think that banks are tighter, rates aren't moving like others thought, and I think that the ease that some of these private credit lenders are providing to investors uh, will keep rates stable or higher, because they're just providing a different service than a traditional lending institution might be able to. And I think a lot of people have opened their eyes to that, both as an investor and as a borrower. So it's also difficult too. There's just so many factors that go
Right.
on, and they're going on at a faster pace than what we're used to too. I mean, Are we going to have inflation? Are we going to have, trade wars? Are we going to, there's onshoring. There's a lot of different things competing for which one wins out. And so I think that there's a lot of patient and growing impatient capital that's still sitting on the sidelines waiting to invest.
Yeah, for sure. Yeah, I agree. And we'll see. So, Ryan, if you could let the audience know where they can find out more about you, if they'd like to connect, if they'd like to join some of these different groups, and also learn what you're personally doing with your funds.
Yeah. So I'm involved with, I'm a fund manager at InvestWise Collective. It's just investwisecollective.com. Passive Pockets is also just passivepockets.com. Anybody who wants to join, there's a free 7-day trial to test it out and see if it's a fit for you. One of the things you mentioned is meeting in person. And so in May, we're going back to our old stomping grounds in Columbus, Ohio, and we're going to have the Passive Pockets Summit,
Nice.
May 2nd and 3rd out in Columbus. And then I'm on LinkedIn. I don't know if I'm the only Ryan Stieg, but I'm one of few if there are more than one. And I was happy to connect on LinkedIn too.
Yeah, absolutely. Okay. And then I've got just two other questions I ask every guest. One would just be any advice you would give somebody who's maybe just starting along this journey. They're just starting out in investing.
Two pieces of advice would be don't feel rushed. There will be deals. Get your reps, look at them. If you find one that fits, great. But don't feel rushed. There will be many deals to look at. Get your reps, ask the questions, get to know the sponsors, get to know community members. And a shameless plug would be plug into a community. Don't do it by yourself. It's something that you learn better through the power of community. So Passive Pockets is a great place to start. But don't feel rushed. Ask great questions, get the reps, and join a community.
Great advice. All right, Ryan, one other question for you. Just a book recommendation. It doesn't have to be real estate related. It certainly can be, but something you've read recently that's been impactful.
Other than the Rich Dad Poor Dad kind of just changing my mindset when I was young, I think that's a great read. And I think everybody knows that book. But as far as passive investing, kind of the book that we all refer to as Brian Burke's Hands Off Investor. Another shameless plug, unintentional, by the way. Brian is going to have a seminar before we start the Passive Pockets Summit out in Columbus on May 2nd, 3rd. So that is a pre-event special that Brian has agreed to put on. So we're really excited about having him out there. But yes, that is a book that I think if you're being serious about investing in real estate syndications, that's a great book to give you kind of a full circle education on it.
Yeah, for sure. We had Brian on the podcast, and I too have gone through and read his book. It's almost like a once a year for me because there's always something new, and if not, just something you can refer back to and reread a chapter when you have questions about certain things. So great book recommendation. So Ryan, this has been fantastic, man. I appreciate having you on The Wealth Flow, and I think we'll call it a show.
All right. I appreciate your time and the invitation.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.